It started in ordinary houses with ordinary people signing ordinary papers. A family buys a home, they take a mortgage. They promise to pay every month. The bank gives them the money, and the family gets the keys. Nothing in that room looks dangerous. Here is the hook. That one mortgage was not meant to stay in the bank. It was meant to be sold. For decades, banks did the simple thing. They made a mortgage and kept it. If the borrower stopped paying, the bank lost money. That made banks careful. Then the system changed. Banks learned they could originate and sell. That means make the loan, collect fees, then sell the loan to someone else. Once the loan is sold, the bank feels less pain if it goes bad. When the pain moves away, the standards often drop. And that is exactly what happened. Now add the mood of the early 2000s. The dot-com bubble had popped, the economy slowed, interest rates fell, lower rates made monthly payments cheaper, more people could qualify, demand rose. Home prices rose, and rising prices created a powerful story. Homes only go up. People started buying homes not only to live in them, but because they expected quick gains. Some bought second homes, some bought homes they could barely afford, believing they would refinance later. Others treated their home like an ATM, borrowing against rising prices to spend. Once a bubble starts paying the bills, people protect the bubble. To feed the boom, lenders offered easier loans. Some loans had low teaser payments at the start, then jumped later. Many borrowers were told, "Don't worry, before the payment jumps, you'll refinance." But refinancing only works if prices keep rising. This is the fragile promise at the center of the story. The plan depended on tomorrow. Another change mattered. Who was selling the loans? In many places, the person across the desk was a broker. A broker gets paid when the deal closes, not when the loan succeeds for 30 years. That is, like paying a builder for speed, not safety. Brokers want volume, so the machine pushed more approvals, faster approvals, and often weaker checks. Now we meet the mortgage machine. The machine had 3 steps: bundle, slice, and stamp. Step 1, bundle. Thousands of mortgages were gathered together into one big pile. Think of it like mixing thousands of different apples into one large barrel. That barrel was turned into an investment called a mortgage-backed security, often shortened to MBS. Investors who bought it would get paid from the homeowner's monthly payments. Bundling sounds safe because of a simple idea. If a few people fail, the rest will still pay. In some cases, that is true. But bundling also hides details. The investor is far away from the kitchen table where the mortgage was signed. The investor doesn't know the neighborhood, the borrower, or the real risk. The investor sees only averages. Distance can feel like safety, even when it is only ignorance. Step 2, slice. The barrel of mortgages was divided into layers. The top layer got paid first. The bottom layer got paid last and took the first losses. This was sold as protection. As long as losses stayed small, the top layer looked safe. Step 3, stamp. The top layers were sent to rating agencies. These agencies gave letter grades like school. BA meant safe. Investors love tradable because many funds are only allowed to buy safe assets. So the machine took risky mortgages, used math to rearrange the cash flows, and produced big stacks of AA paper. When a label becomes valuable, people build factories to produce the label. Why did so many smart people believe the AA labels? Because the models used a dangerous assumption: home prices across the country would not fall at the same time. In the past, one city might fall while another stayed stable. The models treated that pattern as normal. But by the mid-2000s, the lending habits were national. The easy loans were everywhere. The same story was everywhere. The risk was no longer local. It was shared. Still, the machine kept running because the world wanted yield. Yield means return. Investors wanted something that paid a little more than government bonds, but still felt safe. Aplo mortgage paper offered that. These bonds were not only bought in America, they were bought by banks in Europe, funds in Asia, and pension managers everywhere. The same safe stamp traveled across borders. The mortgages were local, but the consequences were global. Demand rose, so the machine produced more. To produce more, lenders had to make more loans. To make more loans, they had to accept weaker borrowers. That is where subprime grew fast. Subprime means borrowers with weaker credit. It does not automatically mean bad people. It often means unstable income, past financial trouble, or thin documentation. The loans were priced with higher interest, but many were also fragile because the payments could rise later. And then Wall Street did something even more extreme. It took the lower, riskier slices and repackaged them again into new products. The new products were called CDOs, but you can think of them as a second barrel made from leftovers. Amazingly, parts of those CDOs also received AA ratings. When leftovers can be turned into prime, the system is relying on belief. One more ingredient increased the danger: leverage. Leverage means borrowing money to buy assets. If you borrow $90 and add $10 of your own, you control $100. If the asset rises a little, you win big. If it falls a little, you can be wiped out. Many institutions used heavy leverage because the assets were labeled safe. Safety encouraged borrowing. Now, watch what happens when the story breaks. Around 2006, home prices stopped rising in many places. New construction had added supply. Interest rates were higher than before. Buyers were stretched. Once prices stop rising, refinancing becomes harder. When prices fall, refinancing becomes impossible for many borrowers. Many borrowers were also hit by resets. A reset is when an adjustable rate mortgage changes from a low starter rate to a higher real rate. The payment can jump in a single month. If your income did not rise, the budget breaks. If you were counting on refinancing, the door suddenly closed because prices were no longer rising. The payment shock was the match, and falling prices were the gasoline. Once homeowners were underwater, meaning they owed more than the home could sell for, the math turned cruel. Selling would not clear the debt. Refinancing required equity they no longer had. Some kept paying as long as they could. Others walked away. Each foreclosure pushed neighborhood prices down, which pulled more homes underwater. The circle tightened. Defaults began to rise. A default means a borrower stops paying and cannot catch up. At first, losses hit the bottom slices, just as designed, but then losses grew larger and spread wider. Here is the key moment. The losses reached parts that had been sold as safe. That shocked investors. If 8AA could lose money, what was truly safe? Now the crisis changed shape. It stopped being only about losses. It became about funding. Many big firms had borrowed short-term money to hold long-term mortgage assets. This is like paying for a 30-year house with a loan that must be renewed every week. As long as everyone keeps renewing the weekly loan, you survive. But if people get scared and refuse to renew, you collapse fast. This is called a run, even without depositors lining up outside a bank. A financial system can survive losses. It cannot survive a run. Why did lenders refuse to renew? Because they could not trust the value of the collateral. If a firm brings you mortgage securities and says, "Lend me cash against this," you need to know what that security is worth when prices are falling. And trading is thin, nobody knows the true price. In that fog, the safest move is to stop lending. So short-term funding dried up. Firms were forced to sell assets quickly to raise cash, but forced selling pushes prices down further. That made the fog thicker. The spiral tightened. In 2007, cracks became news. Some mortgage lenders failed. Hedge funds tied to mortgages blew up. Banks announced huge write-downs, meaning they admitted their assets were worth less than they claimed. Still, many hoped the damage was contained. Then, Bear Stearns faced a run on its funding and had to be rescued. The message was clear. The problem was not only mortgages. The problem was trust. In finance, trust is oxygen. Banks lend to each other every day. If they fear the other side might be hiding losses, they stop lending. When lending stops, the whole system tightens like a fist. In September 2008, the crisis turned into a global shock. Lehman Brothers failed. Lehman was deeply connected to other firms. Its failure made everyone more afraid of everyone else. Money market funds, normally seen as near cash, were hit. One large fund broke the buck, meaning it could not keep its value at $1 per share. People rushed to pull out money. That panic spread into the shadow banking system. Short-term funding markets froze. Hook. The crisis became a run on the idea of safety. At the same time, AIG, a huge insurer, was collapsing under demands for cash. AIG had promised protection on mortgage assets through contracts called credit default swaps. Think of a credit default swap like insurance on a bond. If the bond fails, the seller must pay. AIG sold a lot of this insurance, believing it would rarely be needed. When mortgage assets fell, buyers demanded collateral from AIG right away. AIG did not have enough cash. If AIG failed, many banks would take sudden losses at the same time. So the government stepped in. Governments and central banks responded with emergency tools. They lent to banks, guaranteed certain markets, and injected capital into major institutions. The goal was simple: stop the financial heart from stopping. The rescue was not about kindness, it was about keeping payments working. Even with support, the real economy was hit. Credit became harder to get. Businesses cut jobs. Construction collapsed. Families lost homes. Retirement accounts fell. Fear moved from Wall Street to Main Street. So what caused the disaster, in plain terms? A chain of "not my problem." Borrowers believed prices would keep rising. Brokers chased commissions. Lenders sold loans and moved on. Wall Street turned loans into safe products. Rating agencies stamped them. Investors bought them. Banks borrowed short-term to hold them. Regulators trusted the labels and the models. When everyone depends on the same assumption, the collapse is synchronized. If you want the crisis in one picture, it is this: long-term promises were being funded with short-term trust. When trust vanished, funding vanished, and selling began. Prices fell, which created more fear, which created more selling. Hook. Once the spiral starts, the system does not need villains, it only needs momentum. After 2008, rules tightened and banks held more capital, but the core warning remained. When safe assets are built on optimistic assumptions, they can fail together. The mortgage machine worked while prices rose. It produced credit, spending, and profits. But it also built a tower on one fragile idea: home prices would not fall nationwide. When that idea failed, the tower did not slowly sink. It snapped. And because the safe pieces were spread everywhere, the fear spread everywhere. The lasting lesson is simple. Finance can turn future payments into today's money, but only if trust holds. When trust breaks, the machine that looked efficient becomes a machine that spreads panic. That is why 2008 began with paperwork. The most dangerous collapses often start as normal transactions until the system behind them is too fragile to handle a bad year.